In today's video, we're going to dig deeper into lending and what you need to know in order to obtain a loan. I have a true professional here with me, Dave with American Family Funding, and we're going to enlighten you just a little bit more on the lending process. So the first thing we want to talk about is credit. And what can you tell us about credit and credit scores for borrowers?
So the one thing I like to talk about when we're talking about credit first off is the credit myth. That people think, I don't have good credit, I can't get a loan. And I gotta tell you, that could not be further from the truth. It's very important to be informed about your credit, and there are a couple of ways you can do that. People use Credit Karma, people will use the credit cards, they give their scores as well. But just realize those scores sometimes can be a little inflated. So what I like to do, there is a website called annualcreditreport.com. It shows you what's on your credit, and it's really good to go on there 3 times a year because you can get a free report from each of the bureaus once a year. So like I set it up and I get one Experian, and then the next 4 months I get TransUnion, and the next 4 months I get the other one.
Equifax?
Yes. Equifax. But that way I'm protected all year. You know, but it's very important to know what's on your credit, and realize the credit scores really have to do with the interest rate, how much you're going to pay, not so much qualification, right? So it's really important to know that don't get in that mindset of I can't get a loan if I have bad credit. Talk to a lender because a lot of times you probably can.
What is a minimum FICO score that someone should have to start the process of trying to get a loan? So
right now, and this was because of COVID, the minimum credit score right now, I believe, is 620 on an FHA loan. So, but that's your mid score, right? Not all scores don't have to be there, just one of that mid score has to be there. So again, people think, oh, I have bad credit. Well, you know what? Your credit might be better than you think it is. So as long as you have that mid score 620, then we can do a loan.
And it's usually good to work with a lending professional, even if you think you can't get a loan right now and purchase, because you can help in terms of how to strengthen that credit score.
Right.
Some people don't have enough credit established because they might stay away from credit cards. So it might be opening an account,
right,
paying off the card each month, and just really building up that credit score. Or I know with some people, you have late payments on maybe a medical bill or something like that, and you can a lot of times get those written off, right?
Right, and there's also, there's a lot of times when people will say, oh, I want to pay off these credit cards because I want to get my debt lower before I get a loan. And sometimes I tell them, you know what, whoa, because if your credit score is good enough, maybe you want to take that money and put it towards your down payment, have a bigger down payment, right? And so it's always better to talk to a lending professional, because you're right. If you're not where you want to be, we can tell you what you need to do to get there. Pay this one off, leave that one alone. This one's not hurting you as bad.
Right. Perfect. All right. So how do we understand the big financial picture of someone wanting to get a loan? You and I talk a lot in real estate terms, but you have what's called a back-end ratio. And so I know a lot of times when I'm talking to clients, I'll use big words like that and they don't understand what that means. So a loan to debt ratio, how do we understand the big financial picture of a buyer?
So again, we'll go back to qualification. So the first thing that we're going to look at as a lender is your debt to income ratio. You'll hear the term DTI, right? And there are 2 ratios. There is the front end ratio and the back end ratio. It's very, very simple. The front end ratio is all of your debt, not including your mortgage payment. The back end ratio includes the mortgage payment. Okay, so that's, and as a lender, we typically look at that back end more importantly because that's all of your debt, right? So we want to make sure that number is right. And for most lenders, we want to see that around 50% or lower. But we use your gross income, right? Not your take home. So that's actually a little bit of a benefit too. But also understanding your financial picture, I tell people all the time that I've been on a diet for 25 years and they always tell me, write out everything you're eating so that way you can see what's on there. It's the same thing with your financial picture. Write out all the stuff you're spending. Maybe you don't need that Starbucks every day. Maybe you can start brown bagging a little bit, and all of a sudden, you start getting a little bit more money that you can save up a little bit easier. But the debt to income ratio is really where we're going to look at, and it's just very simply how much income you have versus how much debt you have. And it's a balance, right? That's if you want to qualify for more, you either need to lower that debt or raise up that income. And the most important thing, get a pre-approval done. Please, I tell people all the time, get a pre-approval done because it doesn't cost them anything.
Right.
And it doesn't cost me anything, right? So that part of it, it's like, it's free for everybody. Get it done. And if you're not where you want to be, we can put you on that right path.
And you can work on a pre-approval without running the credit, right? I know every time credit is ran, it'll take a hit, but a lot of times lenders will see, obviously, someone ran their credit multiple times shopping for a loan. So is that possible?
So it is possible. I mean, I don't really, to be honest with you, I don't like doing that because I can't give an official pre-approval unless I run your credit. But if you want to get a basic idea and you can tell me, I'm paying this much for my car, I'm paying this much for my credit cards, you know, I'm paying this much for my student loan, you know, I can kind of start figuring that out a little bit. And so, yeah, we can do it, but then also when it comes to the hit on the credit, there's a couple things you should know there that, again, remember, credit scores only have to do with your interest rate, not your qualification, right? And so you don't get hit that much, but interest rates are done in what I call buckets. 681 to 700, 701 to 720. So if you're at 719 and we run your credit and you go down to 712, you're getting the same interest rate, right? Because you're staying within that bucket. And then another thing, if you're talking to me and another lender, if they all run your credit within 30 days, it only counts as one hit. Because the bureaus are looking at that, they're going, okay, this person is obviously shopping for a mortgage, right? So we're not going to hit them every time. It's the same thing if you go to a car and you're looking, and Ford runs your credit and Chrysler runs your credit, it's only one hit on there. Because they know, okay, this person is shopping.
All right, perfect. Yeah, and that's also good to know because sometimes you'll see that buyers have different interest rates. So what is the fluctuation of the interest rates? And I know a lot of times online, they'll guarantee a certain interest rate, but no one sees the little disclaimers that says, once your credit is ran, that interest rate changes. So it's always good to talk to someone and know that your rate is dependent on where your credit score is.
And when I talk to people, when I talk to people about rates, I'm not going to do that really fast talking afterwards either. I give you the actual rate, but then one of the reasons rates change every day, you know. So they're not moving around very much right now, though. I will tell you, they've been kind of flat for a long time.
And they change with markets. So interest rates are always going to go up, they're going to go down. Real estate is in cycles. I always like to call it seasons, like we have in seasons, but they're just longer seasons, 5 to 7 years. And it is important to look at your budget when you're wanting to purchase a home. I know even for my husband and myself, on a personal note, we figured out if we didn't eat sushi every Sunday afternoon, we could afford the higher mortgage payment.
It's amazing how quickly it adds up.
It is when you really start to look at what you're putting on credit cards or what you're doing. Like you said, the Starbucks, it's amazing where you can find some extra money.
Yes.
Okay, so another is a lot of people ask about paying points on a loan. How do you know if a lender is charging points on a loan? Are there hidden fees that buyers need to look for?
Right. So okay. So we'll start with a point. So a point is 1% of whatever the loan amount is. So if your loan amount is $500,000, 1 point would be $5,000. Now, here's the thing: you don't have to. When we talk about points, it's not just a quarter point, a half point, 3/4. It can be 5/8 of a point. It can be, it's all in and when I look at interest rates as a lender, I'm not like, because people ask me all the time when they find I'm a lender, what's your interest rate? Well, it's kind of a tough question to answer because when I'm looking at rates, I'm looking at everything from 2.75 all the way up to 5%, right? And it just depends on where you want to pay for points or not. So let's say the just no point loan is 3%, fine. And you say, you know what, I want 2.75. I'm like, okay, 2.75, that's going to cost you about $2,000. That's paying points. You're saying, well, you know what, I need some help with closing costs. I don't mind paying maybe, 3.5. I'll say, okay, well, 3.5, there's a lender credit that we're going to give you $3,500. And so when we're looking at interest rates, that's kind of what we're looking at. Let's find that number that works for it. When I'm quoting rates, I always quote no points to begin with. But then we start having that conversation of, do you want lower rates? Do you want a little bit higher rate? And that's when we figure out if you're buying points or not. A lot of times where some lenders move those in there, right, is you're doing a loan for $500,000, your closing costs are, $5,000, but I'm just throwing numbers around there. And then all of a sudden you look at your loan is now $510,000, and you're like, wait, well, where was that other $5,000? And they're like, well, there's no points or fees. It's like, yeah, but my loan just went up. That's an area where you need to look out for. other times they'll call it something else, the administration fee or processing fee or whatever fee. I mean, one of the things I'll tell you about us at American Family Funding, yes, we charge fees, but we're going to tell you what everyone is, and we're going to be very upfront about it. That's one of the things that because I don't like that when people do that to me, if I'm going somewhere and all of a sudden things are not right. So, but that's what, you got to look at all those line items when it comes to the closing costs. And I know we're going to talk about that in a little bit, but that's kind of the area where you really want to delve in. And I will tell you, listen, we want to be a knowledge source here in Santa Clarita, in the Valley area. If you want me to take a look at something from another lender, I'm happy to do it.
Well, and another thing is letting clients know, don't walk in and say, I want a 2.65 interest rate. Because if you walk in and tell a lender that, they're going to say, yeah, we can give you that. But they don't tell you that they're going to charge you for that rate. Exactly. So if you don't qualify for that interest rate and you walk in with a number that you want, they're going to say, yep, no problem. But then time and time again, you end up finding, well, they're charging you for that rate.
Yeah, absolutely.
Anybody can give you whatever rate you want, but there's going to be a charge behind it if your credit score isn't where it needs to be in order to get that specific interest rate.
And the other way you can kind of check it is there's your interest rate and then there's your APR, right? And the APR is what they do with the APR is they take your loan, $500,000, they take all of the cost, $10,000, they put that in and then they amortize that over 30 years and they say this is what your interest rate would be including the costs. So you want that APR and that interest rate to be pretty close. It should be interest rate 3%, APR 1.9 or maybe even 2 somewhere. If your interest rate's 3% and your APR is 3.5, they're putting some fees in there that they're not telling you about. And so that you want that APR to be pretty close.
All right, beautiful. And last but not least, let's talk about closing costs.
Okay.
I know that the percentage of closing costs can vary because depending on what time of year you're purchasing, sometimes your closing costs are higher, right? Because you need your impound account for property taxes, so sometimes it can be higher. So it's hard to come up with a specific amount, but it's usually between 2.5% and 3%.
Yeah, that's a good rule of thumb. That's what I tell people. Yeah, somewhere in that area. And closing costs gets, is a huge umbrella that everything gets thrown into. But what we really talk about, because again, those property taxes and insurance are an important part of that discussion, because closing costs typically are your lender fees, your escrow fees, and your title fees. Those are what I call closing costs. Those are the people working for you. They're the ones that are going, that's what you're paying for. Property taxes and insurance, that actually gets lumped into closing costs, but in my opinion, it really shouldn't, because it's something that you're gonna have to pay regardless. It doesn't matter, and it's going to the government, and it's going to your homeowner, but they lump it in. And when you're talking about the time of year, so on a regular, just, in the middle of like July, well, if you want an impound account, we have to collect enough money for that impound account, so when it's due, we have enough money in there. So we usually collect I think it's 3 months of property taxes and 2 months of insurance, right? But if you're buying a house near November, we have to collect that first installment of that property taxes. So now not only are you paying that $3,500 for that one installment, I'm also collecting for another 2 months for the next one. And so that's where it goes up. But again, that's closing costs that the lenders really have we have no control over. It's just those are the property taxes that have to be paid, and so that's why that number gets kind of crazy a little bit.
Well, and it's almost as if for some of it having a savings account, because it's going back into paying your property taxes, paying your insurance, and establishing the beginning of your mortgage and what your mortgage payments go towards as far as your escrow account.
And when you get your loan estimate, and nowadays every lender has to provide a loan estimate, and what I'm trying to get people to start calling this, but I'm only one man in a huge industry and nobody listens to me, they're prepaids. They should be called prepaids, because what you're prepaying that taxes, you're prepaying that insurance. So again, and you don't have to, sometimes you don't have to have an impound account. It's completely up to you. The numbers are the same, whether you're doing it through an impound account or whether you're doing it through, and we should explain, an impound account means you're paying those as part of your mortgage payment, right? So you got your mortgage payment, then you have your principal and interest, property taxes and insurance, that's when you're impounding. You don't have to impound, so you can just pay your principal and insurance. You can pay those property taxes and insurance on your own, but the number's the same, so it's just personal preference.
Yeah, and it's part of your first mortgage payment.
Correct.
So if you close escrow in July, you don't have your first mortgage payment until September. So it's understanding that it's a lot of those costs as well already built in. So it's a cost in order to purchase a home, but it's almost money going back to you in a sense of it's taking care of your property taxes and your first mortgage. So
yeah, anytime you close a loan, that next month is because you're basically that first payment's in that loan, and so then so you're right, you're always skipping a payment.
And sometimes with clients, if they have enough money to pay their closing costs, but maybe they need a little bit lower payment or they need a better interest rate for a year or two because they might be getting a promotion soon. Sometimes you can even use closing costs to buy down your interest rate, right?
Yeah, you can do that too. So yeah, that's back to where we can, you have those lender credits in there and things like that. So those, like I said, interest rates and credits, there's a lot of not negotiation, but there's a lot of discussion that needs to happen to what your comfort level is and where you want to be. So it's one of the things I spend most time on the phone with clients is going over those numbers and figuring out where we want to be.
And it really is good to have a lender that you can discuss all of that with, because then they can make sure that you're within a comfort level in terms of your mortgage. And then also, even if the real estate professional you hire has a working relationship with them, I know with clients when they tell me, I want my mortgage to be no more than this, as I'm looking at properties and as I'm trying to figure out how to negotiate those properties, then I work with the lender and I have them run the numbers for me, and they can break everything down where we can see what is the best way to negotiate the contract in order to keep you at that comfort level. So it really is important to start with a lender, go through the process, and really have an understanding of the entire financial picture.
Yeah.
Thank you so much, and
it's my pleasure.
we will have a handout down below. You can click it and it'll have all of Dave's information if you want to reach out to him.